Thanks for the opportunity to present here today. So look, for Greatland, we fundamentally own 100% of both the Telfer and Havieron mines, and they're just 45 kilometres apart. So that existing infrastructure at Telfer really lends itself to the brownfields development of the Havieron ore body. During the year, we were previously listed on the AIM up in London. Post-acquisition of Telfer and Havieron, we've also listed here in Australia. And when you look at what we achieved in FY 25, which was just 7 months for us, we did just under 200,000 ounces at $18.49 all-in sustaining cost. We generated over $600 million at the asset level during those 7 months, and that left us with $575 million in the bank. So the cash generation that we're achieving at Telfer has been quite remarkable. Guidance into the new year from 260 up to 310,000, and at an all-in sustaining cost a bit higher, which just reflects that we had some stockpiles to put through in, or a greater weighting of stockpiles to put through in FY 26. And look, there's a big mineral resource there of 10 million ounces and plus 387,000 tonnes of copper. And we've got a very substantive drill campaign, but also the opportunity to continue to extend the life at Telfer with that CapEx profile. We've built up the register, well covered by institution brokers. And really, at a glance here with Telfer, we've got this large-scale, both open pit, underground mine, and the infrastructure there is quite remarkable. 20 million tonne train, 20 million tonne processing in two 10 million tonne parallel trains. It's the third largest processing infrastructure in Australia gold. That's allowed us to really focus on the asset with that infrastructure in place. And the endowment here at Telfer Havieron collectively is over 25 million ounces. This is a globally significant endowment. And when we look at the resource just at Telfer, we've got 3.2 million ounces of gold there, plus 117,000 tonnes of copper in that same volume. It's really attractive for us. Then when we come to Havieron, with Havieron, it's a world-class new high-grade development for us. It's effectively brownfields because we get to leverage that existing infrastructure that we have at Telfer by bringing the ore that we mine from the underground at Havieron back to Telfer. It effectively means what we'll do is move from a mill that's fed by the Telfer open pit, the Telfer underground, and the Havieron underground. We have the feasibility study coming out in the December quarter, so we're not far away from that. Originally, there was a pre-feasibility study done at 2.5 to 2.8 million tonnes, and we intend to come out with the feasibility study on a bigger scale, which shows a ramp up through that 2 to 2.8 million tonnes up to 4, maybe a little bit over 4 million tonnes. So we're excited about what that does for us, and with the infrastructure that we have already at surface, it's a relatively low capex to take us up to that higher volume, albeit a lot of additional underground development and ventilation. And then the resource development there, 7 million ounces of gold, remains open at depth, remains open on the lateral levels. Plus this has a little bit more copper in it, 275,000 tonnes of copper in that same volume. This is just where we sit in the ASX landscape there as a mid-cap. We're kind of new to the block, just kind of listing in June. So we're still really establishing ourselves, but for us it's just a matter of delivering ounces and a series of strong quarters, and of course coming out with the Havieron feasibility study. In addition, as we go into early FY26, into the early calendar year 26 year, we'll bring out a JORC resource on Telfer in the March quarter, and then in the June quarter a JORC reserve, which I think will just start to be able to better articulate the mine life extension opportunities we see at Telfer. Look, the team we have to put this together, we have a number of us out of Northern Star. Simon Tyrrell, our COO, he's got a really good pedigree with infrastructure and project development, particularly around the productivity gains we're getting out of that mill. Sean McLaughlin for the underground. He's got a background with Barminco. We use Burncut as our underground contractor. So again, really well placed to drive the productivity. You've seen we've taken monthly production, development metre production from just under 200 metres under previous ownership to over 480 metres per month in development. So that increase in productivity in the underground has been really important for us. Got Mark, Otto in the mine planning, Michael, it's a really good team, and it's given us the ability, you see, to drive down costs and increase the productivity at Telfer. So look, the financial highlights for FY25 we think are really strong, particularly when you recall that this is just 7 months of production data. A little bit shy of $1 billion on revenue. We got a really strong average average gold price of $4,785 an ounce. We're unhedged. We do have some put options, but puts are the path of least regret. So they're out of the money, so we're just delivering into the market. Give or take, I think we actually had the highest average gold price received. Drove a really strong EBITDA there of $526 million, a little bit less than the cash generation outside of $610 million, but we're making over $2,000 an ounce. Across those big volumes, that's really strong, and you see the EBITDA margin there at 55%. So again, the margin we're making there at Telfer, which to some extent is a stepping stone to the stronger, lower cost, higher cash flow production at Havieron, we think is really advantageous for us. In terms of the acquisition, as I said, at a site level, we've generated $610 million of cash over that first 7 months. You see that in the bank balance of $575 million with no debt. And we bought the asset for just over $540 million. That includes both cash and scrip consideration. So we've basically paid back the asset inside of 7 months. For good order, when we deliver Havieron production, there's US $100 million contingent consideration to Newmont. That would be paid into up to $50 million tranches. But again, we think we're really well placed, and we've created a lot of value for shareholders just through the acquisition, driving the productivity and extending mine life. I think when we bought it, it had 6 months left on an 8-month mine life. 10 months later, we have about a 2-year mine life in front of us, and we're drilling a lot. We're doing 240,000 metres of drilling in this FY26. That's the most in the history of Telfer. And a little bit like James was describing beforehand, there's been a lot of work at Telfer understanding the geology over a 50-year period. But what we've been able to do has been a bit drill-starved, hasn't been able to get that asset allocation of CapEx and exploration budget inside the Newcrest portfolio. We can come in, surge a little bit this year in the exploration, and then move out that bow wave of mine life back out in front of the mine. Just the infrastructure we have, as I said, is the 3rd largest in Australia. We love the flexibility of it being 2 10 million tonne trains. Even if we're just running one of those trains. We're still the fourth largest gold processing centre in Australia. But right now we continue to run both trains, and we have a really clear mine life over the next 2 or 3 years. But as we bring on Havieron, what happens is the centre of gravity for filling those mills goes to that 20-year life at Havieron, and then Telfer, which is a lower grade, becomes the augmentation of that mine feed. But with that mine grade at Havieron about 5 times higher than the grade we'd be displacing from the Telfer open pit, we really like what this looks like when you introduce that Havieron ore into the mix. And I just talked about the extension of mine life here. This is just our cycle of investment. It's driven off that exploration base, but we really feel positive about what we're seeing in that underground and increasingly in that open pit. This schematic kind of gives that, just shows that visually for you. So our centre of gravity for mining right now is in that West Dome open pit, and that blue halo is effectively what we're drilling out across that drill campaign in FY26. Really significant areas. If you don't have a laser pointer, but if you look at that stage 7, that's going to add about 2 years to the mine life. That takes us out to FY28. But when you look at that eastern side of West Dome, it's actually a much larger volume area. That's where we're really focusing our drilling, and we're excited about what that can deliver for us, and we're getting some really interesting results out of that. As we go into the underground, Main Dome, 30-year underground, continues to generate ounces for us, and we continue to add to the mine life. That ESC about halfway up next to the number 3, we really like what we're seeing there. That's only about 50 metres off the current development. It's just shown there kind of the initial hits up there, the top, but that seems to go down vertically a long way. That gives us a lot of addition to our existing mine plan in the Main Dome, and then we go across to the Main Dome underground. The Main Dome underground, we released those first 20 drill hole results separately about 2 months ago. That is the first time, remember 30 years of mining under the Main Dome underground, and then first at bat into this West Dome underground, and we've hit the highest average grade seen at Telfer since 2005. Big, 28 metre kind of widths, and nice continuity there, we think, and then we can pull that vertically back along that drive to the bottom of the shaft, where it can feed straight into the mill. I think it's a year or two away from development for us, but just being that high grade and the volumes we're seeing there, we're really excited about how that augments that Telfer underground. This is just the regional setting. Look, you can see Telfer and Havieron, they're about 45 kilometres apart on the map there. As I said, we'll feed the Havieron ore back to Telfer, but we've got a really extensive footprint, and that circumference, that circle there you see, that's our Indigenous land use agreement. So everywhere within there we effectively already have Indigenous agreement to develop. That's hugely advantageous in terms of the acceleration of discoveries or new mining areas into the mill. It also approximates truckable distance, so we like how that complements and what we've set up. And we inherited that from Newcrest. They did a really good job, and we like to think we continue to engage really well with the community. This is just Havieron. Look, it's the second largest development asset in Australia. It's already under construction. The first decline's about 340 metres advanced. De Grey is the other kind of standout asset, which Northern Star acquired for, I think, $6 billion last year. So, yeah, it really reflects well on the opportunity we have for a brownfield development at Havieron. This is the Havieron ore body itself. It's a beautiful underground, sub-vertical. The existing mine plan is really just on that red zonation, what we call the southeast crescent. That's 51 million tonnes. At the old 2.5 to 2.8 million tonnes, that was a 20-year mine life. And what we're saying is we're going to drive that up to about a 4 million plus mine plan. Because we've got the mill capacity, we can accelerate those ounces through the mill. It continues to be open, plus the vertical extent, pressing out further to the north there or across the screen. We like how we're set up, and this is a big sub-level open stopes that we're putting in place. Our average stope size here will be over 100,000 tonnes. Just to put that in context, average stope size in Australian underground mining is a bit under 10,000 tonnes. So it's an order of magnitude bigger, which drives this potentially lowest quartile costs. Certainly you saw very lowest quartile costs in that pre-feasibility study, and we like to think we can hang on to that into the feasibility study. And then just a final slide, just our position today, debt-free, $575 million in cash, which we've all generated basically in the 7 months post-transaction. We have, in terms of developing Havieron, not only do we have that $575 million in the bank, but we have a commitment from ANZ, ING, HSBC, Tier 1 banks for $750 million. For good order, that's subject to the final feasibility study, but that gives us really good headroom in terms of the CapEx outlay to deliver the asset. And I'd like to think at 5,500 Aussie gold price, we can continue to add to that cash balance at Telfer. As I said, we don't hedge, but we have put some put protections in there. You can see the book, 4,200 ounces. That's still a really good price. It's $1,300 out of the money. We love the fact that they're expiring unused, but it gives us a nice bit of protection, and that really sets us up for success. So with that, Whipple, I'll just see if you've got any questions.
We do have some time for questions, Sean. And before questions from the floor, I'll just ask you, you're another Australian company that's got a very aggressive drilling program. You've mentioned it in your pack here, 240 kilometres. Where is that predominantly split?
Yeah, look, the majority of it is in the open pit, but it's really spread relatively evenly across both the open pit and the underground. We've got 3 rigs in the main dome underground, got 2 across in that west dome underground. We like what we're seeing there, so we'll potentially share that with the market in a separate announcement. And then we've currently got 5 rigs on that west dome open pit, just adding to that inventory. So again, that should all feed into a March JORC resource update. We'll try to get a drill cut off around 31 December, and that will give a bit of a let us show for the first time the size of the prize.
I believe there's a question at the back there, Bob.
Sean, when do you think you'll get a better understanding of where these ore bodies at Telfer end? I mean, you've got that massive shaft that does 5-6 million tonne a year, changes the economics of underground potential, West Dome into West Dome underground. I mean, you'll be drilling for a while, I imagine, before you can really get to the bottom of where this stuff actually ends.
Yeah, it's a good question. I think when we look at that main dome underground, as I said, 30 years of underground mining still going, and we see new areas like the ESC just 50 metres off development, and that we think is actually a substantial area. If you go down the bottom, you've got the vertical stockwork, and you've got some of these higher grade Ray and Kylo areas as well. So, it's a busy system, it's a big endowment, you're rewarded for drilling. And the analogy I'd use is Northern Star. We bought 6 assets off majors. 4 of them had a mine life of less than 12 months when we acquired them. All 6 of those are still in production a decade later. And that's very much what I see here as the opportunity at Telfer. That West Dome underground, it's the same geological unit as you're seeing under Main Dome. So to have that as a brand new area, and the first time you drive into it, it's plus 4 grams, beautiful big mining widths, long strike lengths. I don't think we could have had a better debut into that area. So that makes us really excited about what we see in that West Dome underground. And then you look at that schematic on West Dome, it's all mineralised. Basically, we just need to give it the time and the respect of drilling, and that's what we're doing in this push in FY26.
Sean, thank you very much. That's time.
Okay.